Alright, so welcome to my YouTube channel. In today's video, you're going to be talking about what transpired in the trading world, what's actually forex trading, and a general idea of what moves the market and what entails the market. So without much ado, let me just jump right into it. So today's trading is 0.02. And the first topic that we are going to be talking about, we are talking about the major currencies that we have. So the first currency is the USD, the US dollar. Okay, so the reason why the US dollar is so popular is because apart from making transactions with the USA, which is the United States of America, we can also use the US dollar to make transactions with other countries. For instance, let's say my country, Ghana, where I'm currently based, wants to make a transaction between Russia. So we are going to buy oil, and then they'll give us oil, and then we'll give them cash. So we'll first of all have to convert our local currency into US dollar. Then we'll make payments in dollars. So that's why the dollar is so popular like that, because it's used for international transactions, not just between USA, but with other currencies, and other currency accept it globally. All right, so the next currency that we are looking at, which is the second currency, is the euro. The euro comprises of the eurozone countries, for instance, the Austria, the France, the Germany, the Italy, the Netherlands, Malta, Monaco, and the rest. So the reason why euro is the second currency pair is because of, this is basically arranged based on the volume, how often the currency pair is used. So that's why the euro falls second. And the third currency pair is the pound sterling, which is for the Great Britain or the United Kingdom. And then the fourth one is the Swiss franc for Switzerland. And then the fifth one is the Canadian dollar, which is for Canada. And then the sixth one is the Australian dollar, which is for the Australians or Australia. And then the seventh one, which is for the New Zealand dollar, is for the New Zealand slide. So the next slide, what is forex trading? Forex trading is basically is a simultaneous buying of one currency and selling of the other. So with this definition, what it means is that we have, for trading or for forex trading, we combine two currency pairs and we look at their strength. So if one is going up, then the other one is depreciating. If the other one is depreciating, the other one is going up. So they are doing it simultaneously. So for instance, when you take the Euro USD, which is the euro and the dollar in the United States of American dollar. So for instance, when you are buying, that means you are buying the euro. You are saying that, okay, the euro economy should go up. That is what you are anticipating, or that is your bias, that you are buying it. And when it goes up, that means what the United States of America's economy, with comparison or with compared to the eurozone, it means that the United States is going down. That is when, if the chart is showing that, okay, this is going down, this is going up, then that means what the United States. Okay, and then vice versa, when the USD is on the chart is showing that it is going down, then that means the euro is weakening and the United States dollar is gaining strength. So if the chart is showing that it's going down, so don't really get confused around this place. I'll be showing you the tools and what the chart comprises. Then you get it, you get the understanding clearer, much clearer. So let's move on to the next slide. So these are the major currency crosses that we have. So we have the GBP USD, which is the greatest pound dollar, which is called the pound dollar, and then we have the Euro USD, which is the euro dollar, and then we have the USD JPY, which is the dollar yen, and then we have the USD CHF. We have the USD card, the dollar loonie, then we have the Aussie dollar or the Australian dollar, and then we have the last but not the least, we have the New Zealand dollar, which is the Kiwi dollar. Then if we have major, then that means we have minor. So we'll go to minor, the minor currencies we have. So you should bear in mind that there's a reason why we have the minor and the major. You have to pay attention to that because of they have something called spread. I'll touch on that when you go to the tools. We have swap, spread, and swap. You are supposed to know all this because of, so when you get swap, you know that okay, it's because I'm trading this, that's why I'm getting swap, or I'm trading that's why I'm getting like less swap or huge swap. Alright, so with the minor currency pairs, we have the GBP JPY, we have which is the pound yen, and then we have the euro NZD, euro QE, then we have the pound CAD, and then we have AUD CHF. So we'll move on to the next slide, which is how to trade Forex the right way. So right now we've talked about the currencies or the instruments that we are going to be trading, and right now you have to have the right mentality to trade. So Forex is not a get quick rich scheme. It's a skill-based business. 90%, even I'm supposed to like do it, 99.9% of the people fail because they skip this foundation. Prices moves based on interest rates, news, and interflows. So the reason why the game is all about, if you don't know the rules, how can you play the game? So you have to know the rules. So then retail traders don't move the market. So we are the retail traders. Those that trade with low capital. For instance, we need a broker, we need an institution to transfer our trade to the larger market. So we are the small retail traders. So retail trader to predict the market is to align with probability. So we'll get to that. Then we'll move on to what moves the market. So what moves the market? We have the first one to be liquidity. So the liquidity we have, under the liquidity we have large banks. So large banks, JP Morgan Chase, Wells Fargo. You've come across this big banks. So what these big banks they do is they actually transfer or make payments. So when they want to make payments between each other, so for instance, maybe they've come into an agreement on a deal and they have to like make payments. So they do it, they have something called Fed wire. Fed wire is like simply means they transfer fund from one bank to another bank via electronically. So that's the meaning of Fed wire. So they are like big players when it comes to the market. So they move the hedge fund. We have the Bridgewaters, and we have a few other hedge funds. So what hedge funds does is that they have a term called they buy and sell at the same time, and based on the volume that transpired, that's when they make their money. So their profit is basically on the volume. So they make money out of the volume. And then we have the institution, which is the third liquidity or the third body that moves the market. So we have the insurance company. So the insurance companies, what they do is, or institution, we have so many institutions, but I just pick the insurance company. The insurance company, what they do is, after collecting your insurance money and all those things, they invest it into other they transfer it using the Fed wire. That's another institution that uses the Fed wire. So with large money, I'm talking about like the millions, the billions, they use the Fed wire. And then we have the government. So let's say if a government who says, oh, I'm going to purchase something in another country, for instance, Russia, US says, I'm going to 1 billion tons of oil in Russia. The transactions also move the market. So the expectations, market expectation. Market moves on what is expected versus what actually happened. For example, CPI. So I'm going to talk about CPI. CPI 2 is for another day, but just bear in mind that it's a tool that is used to measure inflation. So CPI, they call it Consumer Price Index, expected to be 3.2, and then the actual is what, 3.2. With that, because we are expecting 3.2, and what actually came out is 3.2, or what actually was released was 3.2. So this one, bear in mind, is a data that they release it every month. There will be no big move after the actual and the expected are the same. Or if the expected is 3.2 and the actual is like 2.8, there will be. Okay, then we'll move on to macroeconomics. The reason why I place macroeconomics as the last point is there because this is a very important one. So we have the inflation, we have interest rates, we have geopolitical tensions, and we have the central bank. So the interest rate, every country has its own interest rate that they release to control inflation and deflation. So what it does is that, let's say they try to like increase inflation so that other investors from other countries can invest into their company, their country. So when people start investing into your country starts booming. And with that, you have to like find a balance, because when you do it too much, you might cause inflation. Yeah. So, and then we have inflation. Inflation is like prices of commodities increases day by day. Then we have geopolitical tension. Geopolitical tension is like the incident or the issue between Russia and Ukraine. Currently, that's what we have. And then let's say China and US, the tariffs that is going on. US imposing tariffs on imported China goods, and then China is also doing the same. So those tensions create what major moves, and like, let me say, those moves could hold on to like months. So I'll be showing you some of the moves on the chart when we get to the technical side. And then we have central bank's policy. We have the BOJ, and then we have the Fed. So there are some policies that the Fed and the central bank, they implement that affect the market heavily. Yeah. So I think that is it for this slide. Watching this video, and have a